You're an author, you're trying to use profit first, but how do you handle inventory and ad spend and publishing cost and debt? That's what we're going to get to in this video. In the last video, we went over the profit first system from the book by Mike Michalowicz, and we talked about the 5 core accounts everyone needs when they set up their profit first system: income, profit, owner's pay, tax, and operating expense. But you could use some advanced accounts to customize the system for your author business. Let's start with inventory. You know with Profit First that we allocate to all those accounts based on a percentage of revenue, but the number we use for revenue is really important. We're not going to use total revenue that you've received from customers. We're going to use what we call real revenue. And real revenue is what's left over after subtracting the cost of the thing you sold. As an author, if you sell a book for $25, but it cost you $5 to replace that book, then your real revenue on that sale is $20. And it's $20 that you're going to use to allocate into those other 5 accounts. But what happens to that $5? You're going to set up a new inventory bank account, and that's where you're going to put that $5. How do we know how much to put into that bank account? You should have a general idea of how much it costs you per book whenever you're buying your inventory. So you technically could look at your sales and figure out exactly how many hardcovers you sold, how many paperbacks you sold, what titles you sold, and what the individual costs were on those. That's going to be really time consuming and complicated though, especially when your volume starts getting bigger. So when you do have that amount of volume, you can look at your averages. What we're looking for here is, on average, what is your inventory cost as a percentage of total sales? Whatever number you need to use to get there, even if it's an estimate at first, that's okay. And the reason that we want to do it this way is because we want to be able to take a percentage of your revenue, of your total revenue, before anything else, and move that percentage of revenue over into your inventory account. And then we're only going to apply the percentages for those other 5 accounts off of whatever's left over after taking inventory out. Let's talk about ad spend. If you remember from the last video, your operating expense percentage starts at 30%. Well, even if you have a 4 times ROAS, your ad spend is 25% of your revenue. So how do you get to 30% OPEX if 25% of revenue is being taken up by ad spend? You only have 5% left to spend on other expenses. The answer is that I don't. If you're less than a 5 times ROAS, then I'm actually going to treat ad spend the same way that we treat inventory. I'm going to subtract that out first before getting to real revenue and applying the percentages for the other accounts to that number. And the reason that I do that is because for authors where your main strategy for sales is through paid ads, typically speaking, if you were to turn your ads off, your sales would mostly dry up. And if you were to double your ad spend, your sales might virtually double. If that's the case for you, I'm going to treat ad spend as like a cost of acquiring a customer, and we're going to subtract that from total revenue before getting to real revenue, just like we do with inventory. And so we're going to have a separate bank account called ad spend. Whenever you're doing your profit first allocations, you're going to subtract out your inventory percentage and put that into your inventory account. And you're going to subtract out your ad spend percentage and put that into your ad spend account, so that all that's left is the real revenue after subtracting those 2 items. And then that's what you use to allocate to the other accounts. In just a little bit, we're going to talk about what to do when you're trying to scale your business, when you're trying to grow. What percentages do you use? We're also going to talk about what to do whenever you're paying off debt. But before we get to that, let's talk about publishing costs. You know that you're going to be writing more books, and you know whenever you write those books, you're going to have things like editing expenses, cover designs, and your initial inventory. So how do we pay for those things? I'm going to have you set up a separate account called publishing expenses. Now, this was not going to be like inventory in ad spend where we subtract those out before we get to real revenue. Instead, this is going to be like a sub account of OPEX. And the way that we're going to figure out how much we put in this account is pretty easy. You know your publishing schedule. You know about how many books you want to release per year. You should also have a pretty good idea of what it costs to do editing, cover design, and all the things you need in the beginning. And you know what your sales have been. So just take whatever that cost is, divided by the sales, and that's what you're going to put as a percentage of income into that publishing cost account. And again, that's going to be a sub account of your OPEX. The way I might do it is have an OPEX general account that maybe has 25% going into it instead of 30%, and then have an OPEX publishing cost account that might have 5%, so that together they make the full 30%. One pro tip you can do: if you're doing pre-orders for your book, you could take the funds from the pre-order and put them directly into the publishing account up until that publishing account is funded for what you need to publish the book. If you want to go one step further, because you might have some cost before you can even put the book up for pre-order, you can take your funds from this pre-order and put it in a publishing account to use for the next book that you're releasing. That way you're always one book ahead on your publishing costs. Next, we're going to talk about scaling and debt. But before I do, If this is sounding confusing and scary and hard to do on your own, you don't have to do it on your own. We're forming an author community where we're going to start off with walking authors through setting up Profit First in their own business. And we're going to also have some templates, some tutorials, some courses, some bookkeeping tips, tax tips, and Q&As. We're planning on releasing that before the end of this year, 2025. So make sure you join the newsletter in the description so that you're one of the first to hear about it. We're going to be releasing this at a reduced cost, so make sure that you join that newsletter to be one of the first to hear. Scaling and debt. How do you handle scaling whenever you're putting aside the percentage you need for your current volume of sales, but you want to be able to prepare for future volumes of sales, assuming that your sales are growing? If you're putting aside the exact percentage you need for inventory and ad spend, but your business is growing and you want to be able to make a bigger inventory order or invest in more advertising, how do you do that? The easy answer is that you just increase the percentage that you're putting aside. So if you're typically putting aside 25% for inventory and you want to make a larger inventory order next time, put aside 30%. You'll use that 25% to replace the books, but then that other 5% is going to accumulate so that you can make a larger order next time. I do want to caution you about something though. Making a huge inventory order just to get your cost per book down is not always a good move. If you're struggling for cash flow, then taking on more inventory than you can handle at the moment is just going to have you putting out more cash now that you're not going to be paid back for until later. There's also additional cost for having too much inventory on hand. So be okay in the beginning making small inventory orders that may mean that you're paying more per book, and work your way towards making larger and larger inventory orders so you can get those costs down. For advertising, same thing. You know that you're going to be spending more on ads next month than you did this month if your sales are continuing to grow. So how do we do that? Again, if your ad cost is 25% of revenue, then you're going to start putting maybe 30% of revenue into your ad cost account. But I would encourage you to think about something. How much are you earning every time you sell something to a customer within the first 30 days? Is it enough to cover the cost of acquiring that customer? Because if you're earning less after you subtract out your inventory cost from that customer than you're spending on ads, then the only way you'll be able to scale is by putting your own money into this rather than putting your customers' money. So think about ways that you can increase your prices, you can bundle books, you can have upsells, whatever you have to do to make it so that you're earning more from that customer in that first purchase than you're spending to acquire that customer. Finally, what about debt? It is so easy to get into debt with an author business, and it is so hard to get out of debt. We think we're just going to get this 0% interest card to fund this first round of books, to fund this first cover design, just to fund this first release, and then we're going to use the proceeds of that to pay off that debt. The issue is, even if you do use the proceeds of that first book to pay off that debt, now you have no money set aside for the next book or for your next set of costs. And so then you have to go into debt again. And usually you're going into more debt than you did before. And so then it starts this bad cycle where you go further and further into debt every time you release a new book. So if you're just starting out, what I'd encourage you to do is figure out how much money you could put personally into this business to get it started as lean as possible without using debt, so that you can start scaling your business without debt. But if you're already into this business and you already have debt, how do you manage this? Specifically things like inventory debt. If you use debt to buy inventory, then a portion of every sale is going to pay off that debt rather than set aside money for inventory. And if you were to start doing both, then it might squeeze your margins so much that you can't cover your other overhead costs. So you have a couple of options here. First, look at the timing of your debt payoff and when you might have to buy inventory again. It may work out so that by the time you're done paying off the debt, you still have enough time left over before you run out of inventory to set aside money for that next inventory order. So if you just bought 500 books and you can have that debt paid off by the time you sell the 250th book, then whatever you were using to pay off that debt for books 1 through 250, set aside that same amount of money from 250 to 500 into your inventory account. Then whenever you go to buy your next set of books, buy 500 again, or even better, buy less if you have to, and pay cash for the whole thing. That way, the very next sale you make, you can put that towards inventory rather than paying off debt, and now you can start getting ahead so that every one of those 500 books you sell from the next set of inventory, a percentage of that is going to your next inventory order rather than going towards debt. And that would be how you're able to make a larger inventory order that next time. What if the timing doesn't work out for you? What if by the time you pay off that inventory debt, you're not able to set aside money for long enough in order to afford your next inventory order? In these cases, it's really important to remember that gradual improvement is better than no improvement. If you can set aside, say, 25% to pay off your inventory debt, and you can put aside even just another couple of percentage points into a future inventory account, then even if you can't pay cash for your next inventory order, at least you have some of the money set aside so that you don't have to go into as much debt as last time. Then the payments on the new inventory debt should be lower than the last inventory debt, so a bigger percentage can go towards your next inventory order because a smaller percentage is going towards your debt. And if you do this enough times, you'll eventually get to the point where you've paid off your debt. I would also really encourage you to avoid scaling too quickly while you have debt. If you're trying to allocate money for the next book and the next inventory because you're increasing sales, and you're trying to pay off old debt, and you're trying to prepare for your current level of sales, you're going to be spread too thin to really make any significant progress. First, focus on getting the debt paid off. Focus on getting to the point where you don't have to use debt again. And then once that's done, then you can focus all your energies on scaling. I've worked with a lot of 7 and even 8-figure businesses that are on the verge of bankruptcy simply because of how much debt they have. They have profit in their business, but so much of that profit has to go towards making debt payments that they can't get ahead. And because of the amount of debt that they have, they can't save for the future, and they're caught in this bad cycle. Get out of that cycle before the numbers get too big. So those are the advanced strategies for setting up profit first in your author business. You don't have to do this alone. Join the newsletter in the link in the description so that you can find out about the community when it comes out, and I will see you next time.